So today marks the halfway point on earnings season. And as Bob Pisani reports, investors are noticing some key trends.
The good news, it looks like we're going to avoid an earnings recession. That would be 2 consecutive quarters of negative earnings growth. With a little more than half of the companies reporting in the S&P 500, earnings are up 0.7%. Okay, that's not a lot, but it's a big change from a few months ago. Analysts began cutting estimates in late December on fears of a global slowdown led by China. By the early part of April, earnings were expected to be down about 3% for the first quarter. But then a funny thing happened. Early reporters like Adobe and Nike reported much better than expected earnings. What changed, everybody wondered? Well, the global growth narrative changed, due mostly to central banks. First, the Fed backed off from any rate hikes in 2019. Then everybody realized that China was stabilizing, not going down. Europe was not as bad as feared, not great, but not as bad as feared. And the U.S. economy was still strong. And then everybody concluded analysts had cut their numbers too much for the first quarter. That's why companies are beating estimates by far greater amounts than normal. So the average earnings surprises for the first quarter is about 7% above the consensus. That's twice the normal percentage beat. Companies typically beat by about 3 or 4%. You have to go back to 2009 to find those kinds of beat rates. So as of now, 2019 will likely see modest mid-single-digit gains in earnings. That's well below 2018's toward earnings growth. That was over 20%, but still quite respectable. The big problem for the markets now is valuation. Stocks are pricey. The bottom line is a lot of things are going to have to go right in the global economy to justify these kinds of high prices. There's not a lot of room for error, and the risk is more to the downside than the upside. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.